The bond market is sitting on a live wire, and almost nobody on Wall Street seems to notice this danger. A Federal Reserve meeting, dismissed as a formality, could quietly restructure an entire economy's financial conditions. Without a rate hike or dramatic announcement, the rules of the entire financial game could permanently change on the 16th of June. The consensus believes Kevin Warsh steps in, signals patience, defers to the data, and nothing dramatic happens. Fewer than 3% of market participants expect any rate cut this year, treating the 16th of June as a placeholder event. That consensus is dangerously wrong, and history shows why new Fed chairs never deliver soft landings. Greenspan raised rates at his very first meeting in 1987. Bernanke did exactly the same when he arrived in 2006. New chairs always use that first meeting to tell the market who they are and exactly what they believe in. Warsh is a hard money chair. He has spent years on record arguing rates should reflect actual inflation, not narratives. The environment he is walking into makes the 16th of June genuinely dangerous, far beyond just his personal philosophy. April CPI came in at 3.8% year-over-year, the highest reading since 2023, and well above the Fed's 2% target. April PPI jumped over 6% year-over-year, the fastest wholesale inflation pace recorded since 2022. That gap between producer prices and consumer prices is a pipeline, not a statistical curiosity. It is coming. What is happening at wholesale level today will be hitting grocery receipts and service costs by late summer. The inflation trend is not cooling. Ed Yardeni has called a July rate hike likely, with current implied probability at only 4%. That kind of gap between expectation and possibility has a habit of closing fast, and it rarely closes quietly. The detail most people are missing entirely is what changes the entire calculus for the 16th of June. Forward guidance removal. Warsh is expected to remove the forward guidance language from the post-meeting statement entirely and permanently. The dot plot, the Fed's rate projection chart, could be eliminated, transforming how all markets price policy. Forward guidance has let markets price ahead for 20 years, keeping the long end of the yield curve predictable. Warsh wants to dismantle that anchor. Without it, the bond market guesses instead of follows Fed intentions. When the bond market guesses, it prices in more risk, pushing yields higher across the entire curve. Higher yields mean higher mortgage rates, tightening financial conditions, without a single official rate hike announced. Remove forward guidance and accelerate quantitative tightening simultaneously, and you have two quiet tightening moves at once. The Fed's balance sheet still sits above $7 trillion, a legacy of 15 years of quantitative easing programs. Every dollar rolling off that balance sheet without replacement is less liquidity available in the broader financial system. For long-duration bondholders, higher term premium means lower bond prices. The math is direct and unavoidable. The 10-year Treasury yield already sits near 4.48%, close to levels last seen back in the year 2007. Remove the forward guidance anchor, and the 10-year yield moves higher, dragging mortgage rates with it. A July hike scenario pushes the 30-year mortgage rate above 7%, seizing the housing market entirely. Mortgages above 7% do not slow the housing market. They freeze it completely and immediately. REITs already under pressure take another leg down when rates rise further beyond current expectations. Utilities and high-dividend stocks face a simple logic problem when the risk-free rate rises above their yield premium. The S&P 500 near 7,600 is priced for a world where the Fed stays out of the way and conditions remain accommodative. Nearly 80% of this year's gains are concentrated in just 10 companies, 7 of them semiconductor stocks. These are long-duration growth assets whose valuations assume earnings compounding far into the distant future. When rates rise, future earnings are worth less in today's dollars. That math does not change for any sector. The crowd simply has not run the numbers yet. The enthusiasm around semiconductors masks the underlying valuation risk. For those arguing the economy is strong enough to absorb tighter conditions, the consumer data tells a different story. Credit card delinquency rates are at multi-year highs, and student loan garnishments are pulling cash from millions of wallets. Real wages are being steadily eroded by 3.8% inflation. The consumer was already softening before Warsh arrived. Layer tighter financial conditions on top of that foundation, and the soft landing narrative becomes very hard to sustain. The market is pricing Warsh as a neutral caretaker who will simply hold steady and watch the incoming data roll in. Warsh has repeatedly gone on record saying he is no such thing. He believes rates must reflect actual inflation levels, with CPI at 3.8% and PPI at 6%. The current rate does not reflect actual inflation. There is a gap. The bond market can see that gap. The only people who cannot are those treating the 16th of June as a non-event formality. A hard money Fed chair walking into the highest wholesale inflation since 2022 is not a formality. It is a confrontation, with bond vigilantes already driving yields near 2007 highs. The Fed is no longer working in the market's favor. When the market understands the Fed has changed sides, that understanding tends to arrive all at once, very suddenly. Stay alert, follow the data daily, and watch the signals the mainstream will miss before the market figures them out.